Welcome to Ticker TV. The Reserve Bank of India has hiked its interest rate for the second time this year, and now its key lending rate stands at 6.5%. The Reserve Bank of India has also hiked its inflation forecast for the second half of FY19, and now it expects the inflation to average 4.8% in second half of FY19 compared to 4.7 forecasted in its June policy. Though the central bank seemed worried about elevated crude oil prices, it said that rising global protectionism will actually drive down demand and can also lead to fall in crude oil prices. What it said about minimum support price hike by the government is that it will have to wait few months to see the actual impact and to what extent the MSP impacts the inflation. Immediately after the decision, bond prices fell sharply. The yields rose to 7.84%. However, neutral stance by the Reserve Bank of India actually means that it may not hike the interest rates. Experts believe that the central bank is done and dusted for this year. Now let's see what Standard Chartered and Edelweiss economists have to say on the RBI's August policy.
So the decision to hike rates by 25 basis points was in line with our expectations. In fact, markets have also taken relief from the retention of neutral policy stance, which in our view was a positive because it is very important. It provides policy flexibility, which is much needed in today's volatile global environment, as the MPC itself has stressed on the fact that rising trade protectionism, elevated oil prices and geopolitical tensions pose grave risks to global growth outlook. Now, both inflation and growth projections have been broadly unchanged with very minor tinkering, and risks to inflation particularly have been cited to be evenly balanced. Now, this is a first for the MPC since December 2017. In fact, they've been highlighting only upside risk to inflation, which it did this time as well because they remain vigilant about MSP hikes, fiscal slippage, oil prices, while they acknowledge that recent softening can lead to some reduction in input cost pressures. Then, MSP hikes, fiscal slippage, oil prices, and also uneven distribution of monsoon. Now, what do we think about the MPC's policy decision going forward? In our view, the policy guidance was balanced, retention of neutral policy stance, and also given the fact that we're expecting a gradual growth recovery, these three factors, in our view, ascertain the fact that there's a high likelihood that the MPC would maintain a prolonged pause on rates for now. They will stay on hold for the rest of fiscal year 2019. Unless and until there is a sharp spike in inflation pressures from uncertainties surrounding MSP hikes or oil prices or the weakness in rupee. Apart from this, if the global markets show heavy volatility, then only there would be a case for reinitiation of rate hikes in our view. So broadly, to reiterate, policy decision in line with expectations A. B. Guidance broadly balanced. MPC also concerned about what's happening on the global economic and market front. And C. After the two rate hikes, there's a case for a prolonged pause on rates unless inflation surprises sharply on the upside or global market volatility increases heavily.
The rate hike by RBI today is more or less in line with the consensus. If you read the policy statements, I think by and large, central bank is concerned about global uncertainties and dollar strengthening. So in order to kind of put back a parity in the currency and the rates environment, there is a rate hike, and I believe going forward there could be a long pause, maybe for the next two policies at least, unless until there is a substantial change in the world over, or there are inflation pressures because of the crude and all these reasons. There could be another relook about the rate hike, but I personally don't expect any more rate action, at least for the next two policies. As far as impact on the bond market, if you see before the rate announcement, the yields in a knee-jerk reaction immediately after the hike, yields went to 783, 784, and they've retraced back, and now they are at around 775, 776 levels. So more or less the market was expecting, it looks like market was expecting a rate hike due to the all global reasons and all that, but on ground if you see the growth has just started picking up, and it's not at a level where we need to be too much be worried about, and the credit growth has also just started initiating, but not at a very large pace. So, and there are better numbers in terms of industrial IIP numbers and all that, but it's not very concerning stage as of now. So we feel there could be a slightly longer pause in the coming time, unless until the inflation risk comes back and there is a reason for a pause, there is a reason for another hike and like that. As far as anything in terms of inflation forecast and all that, it's all within the line. It's not expected that the CPI is likely to moving beyond 5% or like that. So RBI's attempt is to keep the inflation at around 4% levels. The projections for first quarter in the next year is around 5, but the CPI expected in the next couple of months or for this quarter is about 4.8%. So it's more or less in line with the market expectation. Precisely that's the reason that market is not too much worried about this rate hike. As far as the resumption of the supply from the corporate bonds and all that is concerned, I feel after this rate hike there will be some amount of clarity in the investors' mind, and interest rates are more or less at around the peak level. Don't see too much yields moving up unless until the inflation fears come back to the people's mind. So we see a lot more issuances coming to the market with the improved appetite from the investors class. We feel the issuers will now start coming to the market to raise the required amount in terms of borrowing from the corporate bond market.